All right, hey, all you devils. Sam here with you on a Sunday afternoon here. We'll take a look at an S&P trade that we're looking to put on early part of next week. It's got a bit of a contingency on it, which we'll talk about in a second when we get to the video. Before I do that, just a reminder here, we are running a little holiday special here. So for Halloween, just talked about this on Friday in the Bitcoin video, 31% off of all of the educational memberships. We'll do that through the end of this month, through the 31st, right? So very easy to do, just in that checkout process when you're at your cart. There's a big box that says coupon code. You'd put in BOO exclamation point, all uppercase, BOO, boo, with an exclamation point. That's running through the remainder of the week, right? Way to save some dough on the educational membership for those of you interested in pursuing the belt system. And essentially, it gets you access to everything that we do. And then additionally, we have 21% off of our indicators. And those of you, many of you may realize that we have a whole full suite of NinjaTrader indicators and bundles and packages. Something new that we're offering here, which I bring to your attention, we're now doing a 5-day trial on all of our indicators, right? So just with the only caveat here is that you have to create a free account, right? So again, no obligation. You're simply creating an account on our website so we have the information, and it happens automatically. So you're going to create a free account, assuming you're not interested in pursuing any of the educational material. And by doing that, you'll have an account. You'll be able to download the trial. That's going to give you, I think we have about 25 indicators now. You'll be able to sample all of them, right, and do that for free for 5 days. Right? So just bring that to your attention as well. All right, that's I think covers both of those here. Okay, with all that said, let's get to the S&P. All right, all you devils, how's it going? Hope you're enjoying a nice Sunday, a little break from the markets. Well, at least I should say traditional markets. Crypto never closes, of course. But I was sitting here, I'm just kind of doing a little research for the week, and came across an article, and it really inspired me to make this video here today. We had talked about doing it on Friday, but we got a little sidetracked here with the Bitcoin video. But this gave me a real kick in the pants to get this done for you guys today. Now, this is a trade that I'm considering. There's a bit of a contingency on it, which we'll look at when we get into the wave count here. But this is a trade that I think is worth considering. And I'm going to try and go through this without any sort of a political bias in terms of my own views. And just be as objective as I can about this. So here's the S&P. I've got a 4-hour chart here. Now we're going to look at the count here. We've been through this a few times, but the premise for this is the fact that I am still of the opinion that we are headed to a contested election. Now I know it's easy to think, well, that threat has passed, looking at the polling data that's coming in. But I would tell you that I think that, well, number one, we're all a little bit reluctant to lean too heavily into the polling data after 2016 and how flawed their analysis was at that time. But the real reason I think that we have a trade opportunity setting up is because of the tsunami of litigation that Trump is going to be faced with if he loses. So I came across my Bloomberg news feed this morning. Let me get to the top of it. All right. So this is the legal threats that Trump will face if he loses the election. Just came out today. So again, regardless of your political leanings, this is worth reading, because what you're going to see here is just, I mean, the overwhelming amount of litigation he's going to be faced with if he loses. Right. So again, no bias here. This is just fact, right? This is all the litigation he's facing if he loses, and there is a lot of it. So you can reasonably deduce from that he has an incredibly high level of motivation to try and stay in office. Let's go back to our chart here. Given that extreme motivation, and while certainly the general consensus now here is that the market's pricing of volatility is implying that the odds of a contested election are reducing, and certainly that's likely being influenced by the polling data. Well, so call me an outlier, but I think the motivation for him to contest the election is so very high that with the slightest whiff, anything that he can cling to for a reason to call into question the results, he's going to do it. Because again, no political bias here, because of this wall of litigation he's facing. So the motivation for him is so very high. I don't even think he's going to need it. I think he's just going to do it because he can. And because he's highly motivated. So we have these, we've talked about this before, certainly members know my thinking here, that we have these conflicting, massively influential conditions in the background. So regardless of who wins, my view is stimulus it's not a matter of if, just a matter of when. So we know that that's going to be massively bullish to the equity markets. Well, so what my opinion is that we're likely headed towards volatility around a contested election, which would likely be bearish to the market. Now, I may not set up a COVID-style crash, but market does not like uncertainty. That would be the height of uncertainty, and I think we're likely to see volatility, and volatility is just code for selling off. Right, so that's what they say to the general public, right? We don't want to say the market's down. We want to say we're experiencing volatility, right? As talking heads will tell you. Volatility means we're going down. So my view is that with a contested election, we're going down, and with stimulus, we're going up. So as we think about that, it's a process of trying to time that, because you wouldn't want to be balls to the wall short knowing that stimulus was just a matter of time. But I do think there's an opportunity here, and it lends itself to an option trade. Now, before we get to the option trade, let's just look into the Elliott Count, because the Elliott Count here is a bit of mixed signals. Now, this set of channels that I have on here, I'm kind of doing a little custom variation here. So I'm connecting the two lows here, and then I'm connecting the pivot high. But I spot in here, there's like a secondary channel that's running up here. So I've color-coded them so you can see the way I did it. So I created one channel and then a second channel connecting the one, right, with the three in the back. Right, so you see the way I've channeled this. What's interesting about this is if you really look at it, above the center line here, right, bullish, right, all of this bullish. Now below the center line, well, that's getting challenged. Right, so here now we get below the center line, and here as we just tag the mid, well, we're a few ticks off the midline. Now as we get into the potentially the bearish side of this channel, I think there's an opportunity. There's potential here for this to break. Now the Elliott Count doesn't give you a clear path to it. So we'll look at that in a second. But just before we leave here, just the idea, because there's been, this is complicated to get a clean impulse out of it. But I think for the most part, this is the most probable count at this point. And part of that is because we take the length of the 1 to the 2, right? Here's where we get our third. I mean, right, it doesn't get any more Elliott than that, right? Right into the pocket, or literally splitting the pocket, right where we're expecting the third. 4 correction, it's shallow, but it's well, I shouldn't say, pardon me, it's not that it's shallow, the subdivision is a bit tight. You got to pull an ABC out of that. But then we go 1, 2, 3, 4, 5, we get our fifth up here, and then yet again, if I pull from the length of the 1 from the 4, here we're getting the 1382, right? So again, if it's not going to be the 100, the 127, 1382 window is next. And then in addition to that, as I recall here, the length of 1 through 3 projected from 4 gets us the 618, the length of the 1 through the 3 projected from the proposed 4. So we get a nice confluence here. The channel, we get the geometry, we get the 1382, we get the 618. So we have a nice technical pivot here, and we get that nice sell-off. So per the count as it's now labeled, we're looking at a completed impulse into a very shallow 2, which is interesting because that's, I believe that's a 23. So if I just pull this up here, right? So we're just barely breaking the 23 here, and it's interesting how that relates to Bitcoin, because Bitcoin, the proposed pivot here in Bitcoin is between the 23 and the 38. So these would be unusually shallow second waves for both of these markets. Right? This would be particularly unusual to only get barely the 23, and it looks like it's all this structure here that kicked that off. But that would be, if this is 1 and that's 2, and then we're going off. So if this is going to, if emphasis if, is this is going to complete as a 5 here, well then likely, right, the 2 is a very shallow 2, and we're going higher, right? And stimulus would support that. So is that what we're headed for? Well, there's certainly you can make a case for a 3 wave here. So we have a contender for the ABC to go in here. Now at this point, there's a contender here that this could be that we could have a running flat here, or I should just say a flat, right? So if this is going to hold as a 3, we're far enough. Now it's 887. It's not quite the 90, but here we'll look at it in a second. That suggests to me something like that would be not unreasonable, and it would be very in sync with an Elliott count here, looking for a correction. Now, if we look at that, so here's November. Well, you could look at it this way. So here would be coming in. Well, here's essentially 3-4 is the election. If we're going to contest the election, then we potentially are, depends on how long that lasts. But something like that looks pretty reasonable to me. Now that's still, and I'm kind of using this, just drawing this over here, kind of using this high volume node here as a location, just a reasonable target. And then you can just kind of build on that. So if that were what we're looking at, if I go right to my pivot here, well, look what's right there. There's our 38, right? Again, it would be even that would be shallow for a wave 2. Not that we never see it. It's just unusually shallow, right? But considering how massively manipulated the S&P is by the Fed, that wouldn't surprise me. And even getting to the 38, you probably got Fed taking action, right? If we were to fall down that, right? They're just determined to keep it up. But a contested election, Fed can do what they like, but that's going to create, again, we'll say it, volatility. So volatility, if we get the contested election followed by stimulus, which ought to be massively bullish to the market. So I am not calling a top. Not even close, because I think stimulus is going to send us way past those highs. I'm talking about over the next 60 days, volatility in the market, the idea that we'd have a flat that would finish down here at the 38, of course it could go deeper. That's a reasonable target. I don't want to shoot for, a retest of those lows. I want to shoot for something that I think is achievable given that volatility, knowing stimulus is in the background. And every time a tweet goes out, whether anyone in the administration or in Congress talking about stimulus, we see the market rally. It's almost 100%. Just a whiff of stimulus and the market rallies. It is what it is. Let's look at this Elliott count, because it's a little bit tough to make sense of. So you got a few challenges in here, and I'm sure any of you that are looking at this have come up with the same challenge here. So the ABC, particularly with the 5 that comes down here, I think then you can dig the 5 out of this, ABC into the B, and we've got all of this. Oh, we get this little shelf here, right? So you want to guess what's there. So we get this shelf of resistance. You think that's perhaps algo based, right? Well, let's see if we can get it right on the pivot here. It's a little shy for that, right? They didn't quite get there. Is it here? Oh, maybe it's here. We get right to that low. So here's the golden zone. Could be they're just those are just stop runs there. But either way, this was our resistance here, and we went down. Here's first target. So this looks like a solid ABC that finishes down here. Now here's where it gets tricky, and again, I'm sure you've all dealt with this. 1, 2, 3, 4, 5. Well, I can get my 1 here, ABC, into my 2. Now this is where it gets tricky. Excuse me. At first glance, you're dying to do this. 1, 2, 3, 4, 5. Well, what's the issue? Well, of course, we get the overlap here, so that's not an option. So can we get this to play as a 1, 2, 3, 4, 5, right? That's mighty skinny on the 4, but it works. Right? It does work, right? So the length of the 1 projected from the 2, right? If I bring that over, we get just long enough, just barely, right? And that's the other reason why you want to put the 3 up here, because look what we do again, right? Length of the 1 for the 2. You want to put this 3 right here, but it doesn't work, right? Because of this sell-off, right? We overlap the 1, so I can't. That won't play. So I can't go 1, 2 into an impulse, or pardon me, into a diagonal here. So you're kind of fucked, right? So you're stuck with the 3, 4 here, which so makes you a little bit hesitant, right? Is that what I got to live with? The size of that 2 to that 4? Well, you want to lean into rule of alternation. That's quite the alternation. But it is technically valid. Does it have the right look? No, it doesn't. But I can still dig that 3 out of there, and that's the only way you can get this to count as an impulse. So here being the 4, if this is the 1, we've not overlapped yet. It does look like we got to go WXY into this pivot here. Now this looks like, well, potentially it's reaccumulation. Add a little Wyckoff onto it. We've got a secondary test and a spring, and it looks like we're coming off of this with an impulse. Now, that's not enough to really call that a hard jump of the creek or the resistance here, just to use more typical language, breaking that resistance. But it does look, if I go down let's go to a 15. Well, yeah, it ain't pretty no matter how you slice it. But 1, 2, 3, 4. So you got to trade it as a diagonal because here's the overlap. And this looks like a 5, right? So it's sloppy Elliott because this looks like 5, that's 3. This looks like 5, that's 3. Good luck getting 5 out of that. So you're a little hesitant to lean into that count. It's not clear, if there's another way to count this. I looked at this. Could we be looking at a B, C into the 3? So with the overlap here, we've got to consider it a diagonal. So maybe you got to go 1, 2, A, B, C into the 3, right? It's not pretty, right? So I don't have a lot of confidence in this Elliott count coming out of here, but this unto itself looks like potentially it's reaccumulation. Now we only know that here if we come out of this with a big sign of strength. But let's say we did that, right? So now you're back here thinking, oh, I've got a 1 wave. Now if we pull back out here, well, now you're thinking, oh, correction's over. There's the 3, the 4 is in. We don't overlap this 1. So I've got to live with this shitty 3, 4 here to give me that impulsive 3, ABC into the 4. I don't overlap the 1. There goes the 1 wave of the 5th, and this trade falls apart. Right? The trade I'm going to propose to you because it's bearish. So I would be reluctant to take this trade if the Elliott doesn't support it. Right? So even though I think that this is a very high probability event because of this, because I think this is a very high probability event. Get this back here. If we accelerate up, and particularly if we take this pivot out, well, then we've got a 5 here. I don't like the trade. If we stall here, and this starts to break down, because you can make a case here. Oh, let's see. Let's go back to a 1 hour. That this is an ABC. So we've had our A, B, and we finish up here as our C. Now, the problem is this doesn't look like a great start to a trend change. And the fact that we're hitting a zone here looks like potentially reaccumulation. This is the hesitation. So I'm saying that this trade is conditional on what the price action looks like early part of the week. I mean, we could take out this pivot before the open of the RTH on Monday, right? We could do this in the overnight. And then this trade, then you would not want to pursue this trade because now we've got a 5 going in here, right? That doesn't play. The key to this trade here, let me relabel it so that it makes more sense with what I'm suggesting. A, B, C here. So we'd have potentially a flat going in. So what's the qualifier on a flat? Well, did we go far enough on the proposed B wave here to make that qualify? Well, all right, this is where you got to make a decision. So I'm going to put on my platinum zone, we've taken to calling this. So if I'm right on these pivots here, so platinum, if we get beyond the 65, here's the 707, 764, 786, 887, and there's the 90. The last one is that, if you can see that, is the 90. Well, that's, as far as I'm concerned, that's close enough. All right, I'm not going to bicker over a couple of ticks and say, well, it didn't go exactly 90, so it can't be a flat. Not that much a purist, but the point being, if we're going A here up to the B, and I'm just tagging the 887, then the potential for that to come down as a correction looks reasonable to me, but this doesn't support it yet. So for that to happen, this is going to have to do this, and then we're going to have to come down. So I'm looking for weakness off of the open, or within well, let's just say it this way. Weakness without taking out that pivot, right? If we take out that pivot, now we got a 5 here, not a 3. Right, and then this trade falls apart. So this is I'm giving this trade to you on Sunday, with the idea being that if we pivot here and we get yet again, so here's the high, here's the lower high. If we get another lower high and then we take out this pivot, so here's where you enter the trade. Right? This is what I'm going to do. I'm going to say it that way. If we break this pivot and we get on the other side of that trend line, I'm in the trade. Pull that off, right? So you can see what I'm after there. A, B, C. Now, what else can we tee up there, right? Well, of course, we can look at a set of median lines if I can get that right on my pivot. Right, so look at that. Just drew it. All right, so you can see what I'm after there. So let's go back out. Oh, let's try a 2 hour here and look at that. All right, so here we go. Off of the low, here's my completed impulse. A, running flat, B. Now, the flat right? We could pivot here. We could pivot here. We don't have to go. We don't have to go beyond this pivot in a flat, right? In fact, it may not be surprised. It would be surprising that we went very deep on this, but certainly we could. So just using the set of median lines here now. Oh God, I had someone make this comment the other day under a YouTube video I was talking about in Bitcoin, where we had a corner pocket here, and I was talking about the 80%. And he said, well, how is it 80% if it's not a golden? A golden is a sweetener. The 80% is there regardless of where this pivots. Right. So, well, in traditional Andrews, right, the pivot wouldn't be beyond this swing here, right? So this is I think it was a YouTube viewer. It was a little confused here that you lose the 80% if it's not a golden. Not true, right? It could be a 50, could be 38, could be an 887. As long as the key to the 80% is that this pivot holds, right? It doesn't matter how high that goes up into this edge, but as long as we hold here and we start away from it, if that pivot holds, 80% we get here, right? That's so I just made that distinction because somebody was apparently confused, although I've said that at least 100 times. But it could be a new viewer, new subscriber. Anyway, all right, so we're putting this. So see how I'm kind of putting that all together down, saying, okay, look at a target down here around 305-ish, 305 and change. So rather than put the trade together in the S&P, where it's going to be a little more costly, I structured the trade in the options market on the SPY. So again, just to review, the entire premise is that we do not put in a higher high here, right? So we now have a lower high. We get a secondary lower high here, and we start to come down, break that channel, right? Now this is the target. So went to the SPYs, right? So here's the SPYs where it looks very similar, right? So here would be target range here. Here's the 38. So here's 305, right? So I put together a trade saying, okay, well, if we get, so there's two things, always a component of putting together an option trade is expectations about volatility. So my expectation is with a contested election, I think it's not unreasonable to anticipate an increase in volatility. Well, where is volatility reflected most, and where we can measure it, is in the options market. So with an increase in volatility, which is essentially saying the increase in the pricing of the out-of-the-money options. That's how it's reflected in the options market. So with an increase in volatility, out-of-the-money options increase in value as the home run ball hitters are willing to pay more for out-of-the-money options on the idea that the market might really, take off one way or the other. So let's see if we can put together a trade here. So this, I gotta blow this up here. So let's see, you guys can see. Here, we'll look at it here on the matrix at first. So see if I can pull this off. So the trade is an 8x8 calendar spread. We'd be selling, and this is very similar to kind of trades that you guys know I like to put on because I like the spread. I don't like to be naked ever in an option trade. I should qualify that. In an option trade, I always want to hedge somewhere. I want to take advantage of the inherent time decay and the time burn in options, and I want to make a volatility assumption. So on an 8x8 here, so I'm put together the trade here. So the capital requirement here on an 8x8 would be just less than $2,000 that you're going to have to allocate to this trade. It's actually going to cost you that to put this on. So, but just think of it as the capital allocation to put on the trade. You're going to start with a delta negative bias, so you're the equivalent of a quarter of a futures contract or 100 shares of the SPY short. Your theta positive, theta being time, so this trade picks up $9.08 every day that passes, at least sitting here currently with, if we're out into January, we've got 83 days left till expiration. Now that accelerates as we get closer to expiration, but then it's volatility positive, $107 per 1 point increase in volatility. So the volatility increase is friendly to this trade. The time burn of the options is friendly to this trade. So here's your P&L curve. Well, here before we do that, let's look at the volatility skew in the options market right now. So in the spider, we're running right here. You can see the gap here. The implied volatility is here. Implied volatility is running at 23.6. The actual underlying volatility is at 16%. So we have a spread here, and that's likely just a function of the fact that we're going into the election. Well, the assumption in this trade is that we could see up to a 5% increase in volatility. When's the last time we did that? Was right over here, right? So we had the implied volatility go to 33%. Well, that would be a 10-point increase in volatility from where we're sitting right here. Now that's in June. Right, here was the little sell-off that accompanied that. You can always see whenever there's a sell-off, that's what they mean by volatility. Oh, we were expecting an increase in volatility. That means prices are going down. So here we have prices go down, spike in volatility. Prices go down, spike in volatility. If prices go down due to a contested election, you'd anticipate at least a 5%. At least, I think it'd be way more than that. But I mean, this would be 10. But let's not be overly optimistic. Let's just consider, in the 3 to 5 range. So that being the case, again, contested election, you're going to see volatility increase. We're volatility friendly. So here's the profit curve on the trade. Now here, this is going out 30 days. I'm going out to November 24th. So we're short the January 307 puts and we're long the February 308 puts. Right, so here they are. That's why it's a diagonal calendar spread. The diagonal, because we're at different strikes, the calendar being we're at different months. A diagonal calendar spread. So we're selling 8 here further from the market. Excuse me, we're buying 8 here as our hedge closer to the market. So looking at that P&L curve, now this is with a 0% increase in volatility, because when you're working with an option model, if I make an assumption on volatility, it makes that assumption from day one. Well, we're not likely to get there on Monday, but over the course of the trade, again, should it be a contested election, that volatility is very likely to increase. So the price is sitting right here. With no volatility, you don't have a lot of room here on the downside before you'd start to get into trouble. So if the market starts to go against you here, if we're going up 52, if we get from 52 to 56, you're down, 160, maybe $200 here. Maybe time to rethink that, because in sync with that, if the market's going up, what's happened here, right? This is likely taking out this pivot. So coming back here. Now, if we start to go down, if that lower high holds and then we get another lower high and we start heading south, well, then this is very friendly to this trade. Now, this is with a 0% increase in volatility. Let's say we go up by 3% in volatility. Okay, now right off the bat, again, it's assuming that from day one, which won't be the case. But right off the bat, you can see if that were to happen on Monday, this trade would already be in a profit. Again, that's not going to happen on Monday. But over the life of the trade, for us to get up to, and here I'm only taking it out 30 days, we could go out, 60 days. So we'll go to day before Christmas, right? Well, markets, I think probably a half day in the market. But look what we're doing here. Now, if we go toward, here's our target at 305. Now you're pulling just close, shy of $3,000 on this trade. Now remember, you had to put up 2,000 to put the trade on, but you're getting close to 3,000 on that. It's not unusual in an option trade to have a 1-to-1. Or even less than that, right? Because of the hedge, right? So I mean, you could make that a 50-to-1 with no hedge, but that's that's a different style of trading. Let's say we get a 5% increase, which is what I'm expecting. Now we're close to 3,300. Now again, remember, it's showing you'd be in a profit from day one, but we're barring the unforeseen, we're not likely to have a 5% increase in volatility on Monday, although, anything's possible. But over the life of that trade, to get up here, to get towards 305 with a 5% increase in volatility, now you're looking at 3,300 on that trade. So it's volatility friendly. The passage of time is friendly to this trade. If I go expiration, oops, wrong one. Now let's go T plus 85, I think was right. Oh, I thought it was. Oh, that's right. Let's do. I thought it was 80. Let's see. Was it 85? 83. Excuse me. T plus 83. All right. So that's when your January options are expiring. Right. If we're at 305 with a 5% increase in volatility. Now this is. That's a little bit of option traders porn, right? You're never going to get that, right? So don't even look at it, right? So I show it to you just so you can see the potential of this trade. If the market were at 305 with a 5% increase in volatility on January 16, actually, yeah, you would make $8,800 or closer to 9. But that's not going to happen, right? The odds of that's not what you would want to trade off of. You'd want to trade off of, because if we have a contested election, at some point they're going to resolve that, and then a stimulus. So you're likely not going to want to stay that long. Oh, shit. I mean, once that would be a few days before inauguration. God knows what's going on in the market right then. So this actually may not be out of bounds here, but you wouldn't want to hold that trade that long. This is really, at 45 is probably a good number of days to to consider holding this trade. So you'd be looking, if you're at 305, here's 304, 305 at that time, you've essentially put up 2 to make 2 on this trade. Consider you're going to likely get a little slippage, so bring that down. Just so put up 2 to make 2. Nice trade, right? And nice little cushion on the way up. If the volatility is increasing, you have some protection on the upside. So if you're wildly wrong out of the gate, right? So back to our drawing here. If this starts to go down, and then it goes up here, and we take out both of these pivots, well, you get out of the trade, right? The premise of the trade is, while we still could have a contested election, the Elliott count would not be conducive to it. So I would forego the trade, maybe look at a different approach. But I want the Elliott count and the technical analysis to be in sync with that increase in volatility and what I'm forecasting as a sell-off into contested election, followed by a massive rally into the next round of stimulus. So trying to play the bank shot is really what we're after here, right? Bank shot. Right? If we get down here, take profit on that, and we're sitting right there, if a heavy emphasis on if, no idea. But if that were to set up, well, you reposition the trade, now do the same thing. With a decrease in volatility, volatility goes down when the market's rallying, with all of that stimulus push, right, which is going to be massively bullish to the market. Right? It's free money. Have at it. All right, there we go. That's 29 minutes. Okay, I think hopefully that got put together in a way that you guys could follow it. Again, just to reiterate, we're shorting 8. Well, you should do whatever amount's appropriate for you. You want to do it to a 5, you can probably do it for $1,200-$1,300. Shorting the January 21 307 put long the February 21. Right, these are not the weeklies, these are the monthlies. 308 puts. Short the 307 January, long the February 308. Right here. Right, that's the trade that you put on. All right, now allow for a little slippage. You might have to fuss with that a little bit to get the fill just right. So you're going to give, you might have to give a little to get that done. So it could be closer to 2,100 to put this on, based on what you can get it filled at, based on the open on Monday or Tuesday or whatever day when we think when we feel like we've got the conditions that are right for the trade to go on, as in we get the lower high here, right? And we don't break this pivot, right? So when to take this trade, right? If it comes down here, we get a lower high and then we come down. That's when you put that trade on, right? So it might cost you a little more to put it on, right? But it's going to be in the $2,000 to $2,500 range to put that trade on, and of course we know what the upside looks like. Okay, guys, there you go. That should give you some stuff to chew on there, and we'll be back for it. We'll probably take a second look at this as we get closer to the election, based on what's happening. Okay, there you go, guys. All right, catch up with you tomorrow.